forward to. All right. So to recap for people watching the recordings, right now we are looking at the Cat Castillo and the cascading dependency sample scenario that we've constructed here locally. This is intended to train a couple of things, train some stuff that we will see on a regular basis locally, and also train some tricks and some things that will appear on the test. In fact, have probably already appeared on the test as you've looked through it, since you've looked through scenarios 1 through 6 on the advanced exam. And one of them happens to be a cascading dependency problem to force you to do exactly this chart analysis. So we've gone through the filing status for CAT, and we're deciding that we are currently looking at, she's followed all the no column, all the no arrows down to here, and we're wondering whether she has a qualifying person for head of household living in her home for more than half the year. So it says, a qualifying person, see who is a qualifying person qualifying you to file as head of household chart, lived with you in your home for more than half the year. They're referring to a chart here that appears 2 pages further. So if we look down here, first is just interview tips for filing status in general, and then second is who is a qualifying person qualifying you to file as a head of household. There are several options here, split out by a number of different things. So first option, she might have a qualifying child for head of household, which is different than a qualifying child for dependency purposes. They're both qualifying child, they both use the exact same tests, but head of household has these additional little factors to take into account. So maybe she has a qualifying child in Dottie, and if that's the case, then it asks, well, is Dottie single? Is Dottie married and Cat can claim Dottie? Or is Dottie married and Cat can't claim Dottie? Well, we know Dottie is single, so the question is Dottie a qualifying child? Does she meet all the tests for qualifying child? If she does meet all the tests for qualifying child, then Dottie is a qualifying person for head of household, even if she doesn't meet the citizen or resident test. And the citizen or resident test is someone normally has to be a US citizen or a resident of North America in order to qualify as US, Canada, or Mexico, in order to qualify as a dependent. But head of household does not care about that in that particular case. There's another potential way that Cat might be able to qualify for head of household, and that is with a qualifying relative. Her father obviously cannot be her qualifying child, but he could potentially be her qualifying relative. And there's 2 different types of qualifying relative who might qualify someone for head of household. That could be father or mother, that's in this case, or it could be someone other than a father or mother. So here we're going to look at the first type of qualifying relative who is your father or mother, and it comes down to can Cat claim the dependency for Manny? If she can claim Manny as a dependent, then Manny is a qualifying person for head of household. If she can't claim Manny as a dependent, then Manny is not a qualifying person for head of household purposes. So this all boils down to her filing status, Cat's filing status, all boils down to who can claim whom as a dependent in this household. So let's take a look at that. We're going to take a look at that overview of the rules for claiming a dependent chart. So name one of the potential relationships we need to look at, and we'll start with that one.
Qualifying relative.
Qualifying relative. So we're going to ask, can Kat claim Manny as a qualifying relative? Or really, can Kat claim Manny as a dependent? So even though the answer should be obvious, we're going to start under the test to be a qualifying child column, because that is where we always start. Is Manny Kat's child, stepchild, foster child, sibling, half-sibling, step-sibling, or a descendant of any of them? No, right? Kat's dad is her dad, not her kid. This is not Alabama, after all. So we fail qualifying child instantaneously. Therefore, we hop over into the qualifying relative column. Can Manny be anyone's qualifying child at all?
We don't know.
Is he totally and permanently disabled?
No.
Then how will he pass the age test for anyone?
Oh, okay.
Right.
Raquel?
Oh, no, I was saying right. I was agreeing with you. No.
Yeah. He's gonna fail the age test for everyone because according to the intake sheet at least, he is not totally and permanently disabled, which means he's gonna fail the age test for everyone. So we do pass the first test for qualifying relative. Test number 2. Is Manny related to Kat in one of the ways listed under relatives who don't have to live with you, or did he live with her the entire year as a member of her household in a way that did not violate local law?
12 months.
Yep, he meets both criteria. Father or parent is one of the quote unquote relatives who don't have to live with you. So we pass test number 2. What about test number 3? The gross income test.
Fails.
He fails. Why is that?
Because they earn $13,000, $14,000.
Okay.
No.
Check into what he earned and read the entirety of test 3. This is very much an edge case, but it could come up. We're seeing more and more multi-generational households where the child is supporting the aging parent.
Well, the income is not less than 5,000 because it says that I'm guessing the 2,500 in retirement was for the year, but it says that another 13,800 in Social Security payments is what he got. So he makes more than what number 3 says. Oh wait, let me read
all of questions. Read all.
Yeah, I was like, wait, let me read the rest.
This is exactly why I'm including it.
Don't include Social Security benefits.
There's a case. There is an edge case where you can exclude Social Security income.
It's unless the person is married filing the time.
Don't include Social Security benefits unless
the person is married, filing a separate return and live with their spouse, which he didn't. So then, yeah, then that's a yes to number 3 then, because then that means he only made 2,500 in that retirement if we count that.
There are 2 potential ways to exclude Social Security benefits. The first one is that whole don't include it unless that situation is happening. Or there's an or statement in there. It's very not emphasized. The other case where you need to include Social Security benefits is if their income, complete income, is more than $25,000 or $32,000, if half their Social Security benefits plus their other gross income is more than $25,000.
Okay.
In this case, so we have to look at this and we have to say, well, he got $13,800 in Social Security payments. We'll round that to $14,000 for simplicity's purposes. half his Social Security benefits, 7,000, around 7,000, plus his other gross income, 2,500, comes out to 9,500. If that figure is less than $25,000, then we can ignore Social Security benefits.
Gotcha.
Okay,
So we ignore his Social Security benefits, and if we ignore his Social Security benefits, does he pass the gross income test?
Yes.
Yep.
so I arrived at this a different way because I didn't go to the 4012. I just went on tax layer. And tax layer said, it's usually 4,700, but 50/50 is the number, obviously. That was the number 2 years ago too.
Yep.
But it said if this person earned more, you can't claim this person as a dependent because they earn. So if I were to go the route without the 4012, I would come up with a different answer.
The filing status wizard lies.
Okay, so I just want to let you know how I.
Yep. No, that makes
Get the
total
wrong
sense.
way. Okay.
It's the same reason why I said qualifying widower that one year.
Okay, yes,
The same reason I got that wrong.
okay.
Never trust the filing status wizard. The wizard lies. The wizard is evil.
Good to know.
One more test to see, is Manny Kat's qualifying relative? Did Kat provide more than half of Manny's total support for the year?
Yes, and
In the interview, Kat outright says she pays for most of the costs of an apartment that she shares with her father and daughter and provides most of the support for both. Sometimes when you ask that question, in reality, the answer can get a little squirrely. It can get to I don't really know. Some people haven't thought that through. And also some people don't know exactly what the right answer is in terms of getting them the maximum refund. If you ever get a, well, I don't really know answer, there is a sheet here that you can just slap in front of them, and it says dependency worksheet for determining support, and it's a lot of math. It asks people a whole lot of numbers. And the fun fact about this sheet is no one ever completes it. You put that in front of them and very quickly one of them says, that's too much, you do it. You pay for most of the stuff, I'm pretty sure. They figure out real fast who pays for the majority of expenses. But this sheet is in the 4012 if anyone ever wonders, or if anyone ever starts to hem and haw about who actually does pay more than half.
so I'm amending mine from single to married, head of household. Because of the,
Potentially. I'm gonna throw all sorts of wrenches in this. So we just determined that Manny could be claimed as Kat's dependent, which also means he could, as Kat's dependent because he is a qualifying relative for dependency. Which means if we go back to the head of household chart, he is a qualifying relative who is a parent, who is the taxpayer's parent, and he can be claimed for dependency, so therefore he can be claimed for head of household status. Okay, what about Dottie? Can Dottie be claimed by Kat?
she was the Gerber baby and she's making $1 million a year for being the Gerber baby or an influencer on Facebook.
So,
She's a dependent, yes.
child, that's easy enough. Is Dottie under age 19 at the start of the year?
Yes.
Yes. Did Dottie live with Kat for more than half the year? Did Dottie not provide more than half of her own support for the year?
Yes.
Dottie is not filing a joint return. Does Dottie meet the qualifying child rules for more than one person?
I don't understand the question.
Can she be anyone else's qualifying child?
Oh, no.
Can she?
Manny,
Manny. Is Dottie Manny's qualifying child? Is Dottie Manny's child, stepchild, foster child, sibling, half-sibling, step-sibling, or a descendant of any of them?
yes,
Is Dottie under age 19 at the end of the year?
yes,
Did Dottie live with Manny for more than half the year?
yes,
Did Dottie not provide more than half of her own support?
correct,
She's not filing a joint return. She meets the qualifying child tests for both of them.
What about the father she divorced from in 2018, who he doesn't provide anything for her though?
He doesn't provide, and more germane to this, did Dottie live with her father for more than half the year? Nope, so he can't claim her. But we do have a situation where both Kat and Manny could technically claim Dottie as a dependent. Or rather, Dottie is a qualifying child for dependency purposes for both of them. This is where I'm going to remind us that we have these preconditions. So Dottie has to be a US citizen, resident alien, US national, or a resident of Canada or Mexico. She is. Dottie has to not be married unless she meets this one little criteria, which she is not married. But dependents cannot be claimed by anyone who can themselves be claimed as a dependent. And what did we already figure out about Manny?
he can be claimed,
Manny can be claimed as a dependent. Therefore, he cannot claim a dependent of his own. Therefore, the only person in the household who can claim a dependency, who can claim Dottie, is Kat. So Kat, and then we just figured out Dottie is Kat's child, who is, let me make sure I'm actually saying this right, hold on. Gotta head back to the head of household. Dottie is Kat's qualifying child who is single, therefore she is a qualifying person for head of household, which means Kat is head of household twice over because both Manny and Dottie qualify her as both Manny and Dottie are qualifying people for the purposes of head of household. They lived with her for over half the year, and Kat maintained more than half the cost of keeping up her home. Therefore, head of household. Welcome to IRS logic, where things don't make real sense, but they make IRS sense. So, everyone follow along? I spend a little extra time on that because these sort of logic trees can get pretty convoluted.
Yes, following along.
Lovely. All right. The 4012 has the answers to everything. So, if you haven't already, you can go ahead and start up Cat Castillo's scenario. If you have started up Cat Castillo's scenario, then make sure you have the filing status proper, but enter it properly, and you should end up with a total refund amount of $4,571.
I got 4905, and I think I got that because I changed it from single to head household.
Okay, so we got something to look at in your return. That's okay. So why don't we go through this as though I was quality reviewing this return. So we've figured out dependency filing status, so I can just go through the filing status real fast and say, cool, head of household it is, then we'll continue. What name did you all put for her? I say as it's on screen.
Catalina.
Catalina C. Castillo. Her social security number imported, and it's a valid for work only with DHS authorization number, which means a couple of things. But next up should be, what birthday did you put for Kat?
4/15/95. Before 11/95.
Okay. You got that off the intake sheet, and then you got that off her document, right? Her photo ID. Oh, it's listed on the intake sheet.
Okay.
Or, sorry, it's listed on the interview. Okay, I should say. On the interview, it says that of the things that Kat hands to you when she sits down with you, she hands you her Spanish passport with a picture that looks like her and a birthday of 4/11/1995. She's written down on her intake sheet, her date of birth is 4/11/1995. Anything suspicious about that? Two questions for you. First, how does Spain do their dates?
Oh, I got the second one, the dates, I reversed them on the, down at the bottom.
And then the other tell is, how did Kat write the birthdays of her parent and child?
International.
International.
Because there is no 13th or 17th month.
There is no 13th or 17th month. This is where that interview trick I've mentioned before about, hey, mention the month of the birthday would really help, because Kat grew up in Spain. Kat grew up writing her dates like a European, in which she puts day, month, year. So her birthday is November 4th.
Mhm.
We have to assume the interview intake person misread the passport.
No, the passport is reading exactly correct because it's a Spanish passport.
Yeah. Yeah. What a good little trick you put in here.
I promise that this is not entirely chock full of gotchas. Those are really the only two gotchas in here.
No, but it's good because we have to pay attention to those details. So
Yes.
yeah.
And it has caught me out before. I have included most of these things here because I have seen them personally, or I have personally fallen victim to them before.
Makes sense.
And this is why whenever I'm entering someone's birthday, I will always mention the month. So, date of birth, November 4th, 1995. Occupation, we can put whatever we want to here. Yep. Janitor, housekeeper, whatever she wants to put. Cleaning professional, 3. Cannot be claimed as a dependent. She is over age 18, but isn't a full-time student herself. She's not blind, she's not dead. She does not wish to contribute $3 to the presidential election campaign fund. She didn't serve in a combat zone. She was not affected by a natural disaster last year. She did not receive, sell, or dispose of a digital asset or financial interest in a digital asset in 2024. We can fill out her address. Zip code, city, state. It actually auto-populates the proper city, or it should.
I made up a phone number because it was a mandatory field that wasn't on here.
No, it wasn't. Did I not put that? Oh, I did not put that. Oops. My bad. But that's all the tricks on the personal information section. In the dependents and qualifying people section, we've already determined that both people are her dependents. So just looking at Dorothy or looking at Dottie's stuff, we have, again, have to amend the name, so Dorothy, and then we have to put Castillo Soto, because that's how the Social Security Administration understands her name to be. And then her date of birth, her Social Security number. She is a US citizen, she's her daughter, and lived with Kat for all 12 months. Click save and enter another, and then enter Manny or Manuel. We don't have his Social Security card, but what we do have is his Social Security benefits statement, and that is a qualifying substitute document. So we have a Social Security statement for Manuel Castillo, his date of birth, February 13th, his Social Security number as written on the benefit statement. He is a US citizen, relationship to Kat as parent, lived with her for all 12 months, and everything is nice and peachy.
That's where I got caught, right there.
Yep,
So-
yep.
So
Uncheck that box.
Thank you.
Yeah, so these check boxes in the dependencies section, they dictate eligibility and criteria that permeate throughout the rest of the return. And so you have to make sure that you select the correct boxes or deselect the correct boxes when appropriate. But those are the two dependents to add in. We thankfully don't have any birth or death certificates to add to this. Thankfully, there is no identity protection pin to add to this return. Now we can enter income. Beginning with a nice simple W-2. It is a standard W-2, has an employee identification number that when you enter that, it should turn up Pure and Clean Associates. At 5811 Ceres Avenue, 75248, Dallas, Texas. It should auto-load Dallas. And her information is here. Her address properly imports or should properly import. And there's nothing tricky about this W-2. It just has box 1, 3, and 5 all matching, box 2, 4, and 6. Well, 2 you have to manually enter, but boxes 4 and 6 should automatically match. Then there's some health insurance information in box 12 alpha, code Delta Delta for 3865. And then this is another one of those employers that has multi-state employees and therefore issues some state tax information. So again, we have to do, well, state ID number, fine. Did I put a state ID number in this one? Nope, so we have to do that substitute ID number. But all in all, it should be a relatively straightforward W-2. This is the point where we then ask her, do you have any other W-2s to add to fulfill our due diligence? She says, nope, that's it. Cool, that means we can move on. She did get a Form 1095G. 1099G, thank you. Details are important. Certain government payments. So this is exactly how a Texas Workforce Commission, this is exactly how unemployment income is going to look in the state of Texas. So again, if we need to find the appropriate place to enter this, we can always just type in the form number, and then it'll show us that there's 2 different places where we can enter this. But we have a box 1 payment and not a box 2 payment, so we can select the appropriate place. It's going to ask for a payer's federal ID number. You can add that in. It may or may not automatically load in Texas Workforce Commission's information. If it automatically loads it in, then we do the standard practice of double check, make sure the TaxSlayer imported the proper info. And then on this form, the payee information is below the payer information. So we have taxpayer info, her address, and then back at the top, we have unemployment compensation. This is box 1. So we enter 2540 there. And then that's it. And most unemployment benefits forms you see will look like this. Very, very few people actually have federal withholding held out from their unemployment benefits, which does bite some people in the butt. That does come back to haunt some folks. We saw a lot of that in 2020 and 2021. Because unemployment is taxable income. We don't have any other 1099-Gs to assess, so that should be fine. Looking at some more tax forms, we have a 1099-K. And this is a just-in-case thing that I'm training you on. This 1099-K is what we feared would come out last year, but ended up not actually happening, as far as I can tell. It may happen this year because the IRS has said for 3 years now that these 1099-Ks for Venmo, Chime, PayPal, other money sending services, the IRS has insisted for the past 3 years that these money transfer services need to issue payment card and third-party network transaction forms for any amount of money over $600 going from person to person. To use an example from my personal life, I play airsoft on the weekends. I have some friends who do airsoft tech work. So airsoft is you run around a field with these replica guns. It's the little electronic like sewing machines almost, and they just spit little plastic BBs at people. The little replicas are notoriously finicky. And so some people have gotten really good at working on them as technicians. One of my friends is a really, really good technician. People will bring their replicas to him and ask him, hey, Seth, can you like tune up my replica? Can you fix it? Can you make it perform really, really well? And he'll say, yeah, Venmo me 200 plus the parts that you need to get, that I'll need to get, and I'll get you a quote for the parts. Venmo that to me, I'll make it happen. Give me a week. Technically, that is taxable income for him. He is doing a small business upgrading people's replicas. Prior to the IRS making this rule, or really prior to the IRS modifying this rule based on congressional direction, that income never showed up anywhere unless he voluntarily reported it, which I have not done Seth's taxes personally, but I suspect that he probably has not voluntarily reported that income. Not many people do. The IRS noticed more and more of this stuff happening. Congress noticed more and more of this stuff happening. And so between the two entities, they started directing these like Venmo and PayPal to start issuing tax forms to anyone who got more than $600 worth of payments.
Used to be 20,000 now.
Used to be 20,000.
100 or 120.
Yep. They said that they were going to do that 2 years ago. And then everyone freaked out and they chickened out and backed off. Last year, they didn't back off. They said, okay, listen, you guys said you weren't prepared for it last year. You've had a year now to tell, and we're going to make it happen. And then they didn't actually seem to enforce it last year. This year, they're saying that they're going to make it happen again. What happens if I purchase 3 Taylor Swift tickets because I'm the one with the fastest internet connection out of my friends, and 2 of my friends just reimburse me for the Taylor Swift tickets that I bought for them? That could easily add up to way more than $600. If they, in theory, what should happen is they should mark that as friends or family or whatever the equivalent transaction is, and in theory, it shouldn't show up on any sort of taxable form. If they mark it as a good or service, or whatever the equivalent is, then it might show up if Venmo were to issue me a 1099-K for what they think is my taxable income, even though it's a reimbursement thing. And you see this all the time, not just with concert tickets, not just with trips. You see this with rent. You see this with friends helping friends make their rent. You see this with family members sending money back and forth.
Splitting a restaurant check.
Splitting restaurant checks, yeah. It can ease, and 600 is such a low limit now that even just splitting restaurant checks on a monthly basis could easily cap out over 600. So if someone receives a mistaken Form 1099-K, how do we deal with that? And that's why Kat got a 1099-K for helping her friend pay her April rent.
So here's the quandary I got.
Mm-hmm.
I know I'm supposed to report any and all income,
Yes.
but this is guilty with an explanation.
Yep.
This is probably the first year that the IRS is going to go ahead with it, so there's probably going to be some sort of dispensation or forbearance, but I can't make that determination. So I was stuck as to what to do.
And this flummoxed us 2 years ago. It's part of the reason that the IRS backed off, because all the tax preparers looked at this and said, why are you making us make this decision? And they were right. The IRS didn't provide good guidance 2 years ago. They provided excellent guidance last year, and this year, for some reason, their guidance has not been as helpful. But I will show you exactly how we address this. We address this by not using the Form 1099-K form in TaxSlayer.
Use another income.
Yep, we use other income. We skip this completely. And now you're looking at me probably and saying, hold on, there's this form here, and you've told me I've told you consistently throughout this process that when you can duplicate a form, you want to duplicate it exactly, right? Well, let's check the 4012. Like I've mentioned, 4012 has the answers to all of life's persistent questions. There's a section for I think it's in less common income.
I just typed other income in the box.
I missed where this goes. 1099-K. Find all results, please. Here we go. All right, this is page Delta 24. It's talking about 1099-Ks. And the magic is there's a frequently asked questions section. And it says, this is an explicit thing that they mention here. My friend and I went to a concert, and my friend reimbursed money to me for her concert ticket through an online application. If I get a Form 1099-K for the reimbursement, do I need to pay taxes on it? And the IRS outright says, because the money is not payment for the sale of goods or the provision of services, generally the reimbursement would not be taxable for you. If you cannot get the form corrected, which good luck getting PayPal to issue you a corrected 1099-K, The error should be reported on Schedule 1. Enter the amount reported in error on the appropriate line at the top of Schedule 1. Well, that's a very terse way of putting that. Not much in the way of details, right? Let me go ahead and open up. I'm going to drag this over from the other screen. I'm going to go ahead and show you how it was explained last year, and then show you that the explanation is ultimately the same this year. This is last year's 4012. If you look up 1099K, same page, and then it has that same set of frequently asked questions, except they were much more explicit in last year's instructions. The error should be reported on Form 1040, Schedule 1, Part 1, Additional Income, Line 8, Zulu, Other Income, with an offsetting entry in Part 2, Adjustments to Income, Line 24, Zulu, Other Adjustments. And just to make sure that they are meaning the same thing when they just say, well, the error should be reported on Schedule 1, you can actually go to the IRS website where they have an entire section for FAQs about the 1099K. I received an erroneous 1099K and could not get a corrected form. The tax software I use puts the gross proceeds amount as a positive and the offsetting amount as a negative here. This is different than the instructions. Is the alternate reporting okay? Yes. So we are permitted to proceed with the old methodologies.
And because the taxpayer signs under penalty of perjury, the 8879, you have it acknowledged that yes, they received the money, yes, I made this adjustment to income, please sign here, and it absolves you of any culpability.
Correct. We are preparing it according to the IRS's instructions. So for this purpose, we would go to the income section. We would go to, hold on. Oh, okay, yeah. It's saying if the tax software does this, is it okay? Yes. Instructions explicitly say put offset amount on Schedule 1, line 24Z, which is the other report. Let me go through this to make sure that they haven't swapped anything around. Get not reportable on, yeah. If it's incorrect. Yeah, if you can't get it corrected, don't wait to file your return. You can zero out the error when you file your return. That is exactly what we are doing. On Schedule 1, enter other income, and then on other adjustments, enter that as well. Yep, so procedure remains the same as last year. So we're going to put other income, income not reported elsewhere, and then you can kind of, on this other income item, there's a drop down of options that you have. Incorrect 1099K is not one of the options. So we have to put other income, which will then open up a, hey, describe this other income that we're talking about field, where we can put whatever will make sure that it's clear to the IRS. In my case, I put improper 1099K. And then we report the amount of other income because we are dutifully saying, hey, IRS, I acknowledge I received this form. It's wrong, but this is what it says. And we put 2,400 for the amount of other income. It's not earned income, so we leave that unchecked so that it does not mess with any sort of earned income credit. And then we can hit continue. And that's going to do things to your income until you go in and find the adjustment section. So remember, adjustments, for some unfathomable reason, TaxSlayer puts adjustments under deductions. So you go to the deductions menu, the adjustments menu under that, and then at the very bottom, it'll say other adjustments. And this is where you can add in other adjustments. It's not any of the given items that you have there. So again, at the bottom, there will be a section that says other adjustments not listed above, and you can enter your own whatever way you want to do in order to let the IRS know. I am using the exact same phraseology between the other income and the other adjustments just to make it as easy as possible to match them up. So improper 1099K, and I zero out the amount. So this is part of the reason that the reason this works is because very little on the return actually pays attention to total income. The reason this works is because we're taking this, we're adding the income and then subtracting it again before we hit adjusted gross income. So in essence, to the IRS, this looks like zero. So that is the 1099K, and how that is specifically how to deal with an incorrect 1099K. Any questions about this before I move on? Because this gets a little bit messy.
Makes perfect sense.
Good.
And that, now that would be where the intake person put other income.
Yes.
Okay, because I wasn't sure if there's something else over there that didn't.
There's also other stuff.
Okay.
One last trick question for y'all. Where do we put Manny's income? His Social Security income?
It's not his tax return.
Not his tax return, yep. We don't have to put his income anywhere because even though he is CATS dependent, or he can be claimed as CATS dependent, his income is his income.
He just update his name from Manny to Manuel.
Yep.
You got alimony received there. I was not able to get that to take. I was not able to open that field.
Oh, interesting.
I type in, but it wouldn't open the field.
Okay. As in like typing it into the form finder?
Yes, sir.
Okay.
No, that opened up like that, but it just wouldn't open a field.
Well, right now it's chewing on things. Or is it?
And I know we're in the test environment, so.
Yeah. Okay, so it looks like TaxSlayer Pro has not quite fixed all of its menu items.
Okay.
But under income, if we need to enter alimony, then we'll need to enter alimony. But Kat has mentioned that her friend says that she shouldn't have to include alimony on her tax return. Why am I adding it here anyways?
Unless her friend's name is 4012, she has no standing.
That's a good answer. But does anyone online know why I am including alimony anyways?
It's income.
It is income. 2017 tax bill got rid of alimony as taxable income. Why is it still here? It's after 2017.
That's sunset in 2025, though.
It does, unless Congress does stuff.
Right.
But alimony requirements, instruments executed after 1984 and before 2019. Look at this note. Alimony paid pursuant to a divorce or separation instrument executed on or before December 31st, 2018 is deductible. For divorce or separation agreements executed after December 31st, 2018, or executed before 2019 but later modified, if the modification expressly states the repeal of the deduction for alimony payments applies to the modification, then alimony is not deductible for the spouse who makes the payments and will not be included in income for the spouse that receives the payments. Kat's divorce was finalized before the magic cutoff date and has not been modified since. Therefore, her alimony is still taxable. A lot of people think alimony just doesn't exist anymore in terms of taxability. It does, and this is why. There's little details. The 2017 tax bill was a train wreck, and this is part of the reason. Just a very small part. But it's still part of the reason that it was so confusing to people. So we do have to include alimony as part of Kat's income, and that's a pretty simple one. We enter the total amount of annual income that she got. So $100 a month, 12 months, $1,200. And then this is TaxSlayer making sure that we are actually entering proper taxable income. If we put this after, or if we put this as January 1st, 2019 or later, it'll say, hold on, this isn't supposed to be taxable. But we enter the date of the original divorce or separation agreement. If they do not remember the date, because a lot of people will not remember exact dates that far back, get as close as you can, and based off of what they're saying, you can determine whether you need to delve deeper and get them to pull up the actual instrument itself, or the actual date itself. If they say, oh, it was in 2016, okay, well, you don't have to worry about the exact month or date. If they say it was 2020, okay, you don't have to worry about the exact month or date. If they say it's sometime in late 2018, probably, okay, then you probably need to ask deeper questions, figure out exactly when that happened. But that's how you enter alimony for the recipient. For the payer, if you're working with someone who's paying alimony and it's considered taxable under this agreement, or under the situation, then you enter that as an adjustment to income. It's money that they had to pay in order to still be in legal compliance with stuff. So the state ordered them to pay it. It doesn't have to be counted as taxable income. That's an adjustment to income. So you, again, go under deductions, adjustments, etc. So Kat's husband or Kat's ex-husband would enter that as an adjustment to income. You click continue, that'll take you in certain places.
And I got the 4571 now.
Now you have the 4571.
So, yes.
Perfect. That means you got it right. Next bit of information for us to add here, we have some childcare expenses. Kat says that she pays a daycare and Sanger to look after Dottie so Kat can work. Kat provides a letter from the childcare center indicating that Kat paid $2,200 for Dottie's care at the for-profit First Steps Daycare with a federal EIN and an address. So this is how you enter childcare expenses so that someone can potentially get child and dependent care credit. First off, there are some criteria to qualify for child and dependent care credit. I'm going to go ahead and look those up just so you can see what they are. Yep. So, who is a qualifying person? A qualifying person to qualify you for taking the child and dependent care credit is one of these three things. A qualifying child who is under the age of 13 and who can be claimed as a dependent. Any person who was incapable of self-care, quote unquote, that's a formal definition, whom the taxpayer can claim as a dependent or could have been claimed as a dependent except that they had a gross income of more than $4,700 or filed a joint return or that of the taxpayer or spouse. Did they not update that? Huh. Looks like they forgot to update that number. Pretty sure that's supposed to be 50-50 now. Or a spouse who was physically or mentally incapable of self-care. And this is the definition. It's basically if you're caring for someone who is very, very high on the disability scales. The qualified person must have lived with the taxpayer for more than half the year. And then there's an entire other publication to go into details about child and dependent care expenses. I will say I've never had to refer to that additional publication. Generally speaking, the child and dependent care expenses that we enter will be very cut and dry, and childcare centers know exactly how to issue the letters that we're supposed to work with, for the most part. There's some other criteria here. So that's the criteria for who qualifies you to claim the child and dependent care expenses. There's other criteria to claim the credit. The expenses must be paid for the care of the qualifying person so that the taxpayer and the spouse, if married, can both work or look for work. Yep. So in this case, yeah, Kat is paying for childcare so that she can go and work. If one of the parents, if you're working with a married couple and one of them pays for childcare, but the other is a stay-at-home spouse, that does not qualify. If they're paying for childcare so that they can do something other than work, that does not qualify. It has to be for work or looking for work. The care includes the cost of services for the qualifying person's well-being and protection, expenses to attend kindergarten or a higher grade are not an expense for care. Expenses for before school care and after school care do qualify. If I have a kid and I send them to private school, that does not qualify me for the child and dependent care expenses. If they're going to private school and I pay the school more for after school care so that I don't have to leave work at 3:30, that qualifies for child and dependent care expenses. And the last thing is expenses for summer day camp are qualifying, but not for overnight camp. That should be a plain and simple one. Summer camp overnight means you're sending your kid off to be temporarily absent from your household period. It is generally speaking not for work. Day camp, there are places out there that bill themselves as camps, as summer camps, but basically they're providing daycare while school is out so that the parent can keep working. And then obviously they have to be claimed as a dependent. And then there's a whole screening sheet of questions that you can ask, of very technical questions that you can ask in order to determine whether someone can or cannot claim someone for child and dependent care credits. There is a limitation. You can claim up to $3,000 of dependent care benefits for each qualifying person. If you have 3 kids, you could claim up to $3,000. If you have 3 qualifying people, you could claim up to $3,000 of child and dependent care for each person. Sorry, I am getting ahead of myself.
Yes.
You can claim up to, if you have 2 people, you can claim up to $3,000 per person. If you have more then you're limited to $3,000 per person and $6,000 total. This is why it's important to, I was looking at the 2023 version. Let's make sure nothing has changed. Qualifying person. All the same things. They have added an additional warning.
50/50.
Yep, 50/50. So this is now updated properly. Yep, qualifying work-related expenses still are the same, and the questions are still the same. Okay. That's your cue. Always make sure you're looking at the current year publications. Learn from my mistakes. Nope, I'm still here. Don't time me out. All right, so childcare credit. You can either have the form number memorized. It's 2441. Come on. Or you can type in child and dependent, if I spelled dependent correctly. And you can click on that. Or you can know that it's a credit, and therefore it's going to be under the deductions top level menu item, which doesn't make sense. Into the credits menu. And then it's the second item on the credits menu. So the way that this works is you have to you essentially have to establish the childcare provider as the first thing. So in this case, we establish that First Steps Daycare exists. Put their EIN. Some people provide daycare out of their own home, family childcares. In which case, oftentimes they will not have an EIN. They will not have a business of their own. They'll just be operating their own small business Schedule C off of their own social. So it's entirely possible you may get a letter where someone just has a social security number. If you need to switch that around, then you can do so with this menu. Select the proper type of identification number, enter the type of enter the identification number here. Put the provider's name, their country, their address, their zip code, their city, their state. There is something here if there's an in-home childcare situation, if someone hires a nanny or a in-home childcare situation, then this is how to add that. That adds some complication to claiming the credit, but this is where we're going to enter that info. Once we've established the care provider, then the next step is to indicate for this qualifying person, we paid this much money over the year, which Kat is getting a tremendous discount. If you don't see the person that your taxpayer is trying to claim for child and dependent care expenses, then that means either they are not actually qualified or you have misconfigured one of the criteria. Maybe you have the birthday wrong or birth year wrong. Maybe something's been checked that should not have been checked, like she earned over $5,050. But for whatever reason, if they don't show up here, then double check that you've got the dependency correct. So you select the appropriate person, you enter the amount paid, and then you can click continue. And that establishes the child and dependent care. And then you have to ask these questions. Sorry, you have to answer these questions. There's a second part to this. For the most part, most people will answer the questions the same way as Kat does in this case. So she did not receive any dependent care benefits from her employer that aren't reported on her W-2. Very, very few workplaces in Denton County have in-work childcares.
Would that be in line 12?
Honestly, I'm not sure where that
I'm not
ends
sure.
up. If the case comes up, the publication 503 will have the answer for us.
Sure.
There's not a disabled or full-time student exception going on here. Essentially, I'll refrain from discussing this more because this is some technical detail that we never see at our sites. And then delayed care payments, did she pay any expenses for 2023 and 2024? No, in this case, all her expenses were for 2024. I didn't explicitly say it, but it is exceptionally rare that anyone actually ends up checking yes to this box. And that's how that works out. That's how to enter child and dependent care expenses. I don't think it's calculated correctly right now. Or I have this misconfigured to where I didn't give her enough income, or maybe I gave her too much income. But if you follow those steps, you will enter child and dependent care credit correctly. Any questions about that credit? Hopefully everyone's figures agree with mine. $4,571 refund. So I'm pretty sure I've finished inputting everything. One thing I've definitely forgotten to do is we need to go to health insurance.
1095.
We need to ask her, did she get a 1095A? Did she have healthcare via Marketplace, healthcare.gov, Obamacare, Affordable Care Act? No, she did not. How do we know this? Well, first off, she says that everyone had health coverage. We see that Manny has Medicare listed on his Social Security statement. And then we can also see that code Delta Delta on Kat's W-2, which means that she's getting her health insurance through her employer. So we answer no, she doesn't have health insurance via the Marketplace. She said as much, and therefore we are finished.
And the EIC populates automatically, but if you click on EIC, there's a whole bunch of secondary questions.
Yes, since today we have a relatively simple set of returns. Well, simple. We have a relatively quick set of returns. I'm going to go ahead and talk about that. We might as well. Earned income credit. there is technically a very, very extensive checklist for earned income credit. So to that end, why don't we go ahead and check via the 4012 and make sure that CAT qualifies. So this is exactly how all of this works. There's rules for everyone. Then there's two different columns for whether or not she has a qualifying child. And then there's an income bracket, or there's an income limit, depending on the household size, or specifically depending on how many qualifying children there are. So we start with most of these multi-column charts, you always start in the upper left. So, rules for everyone. Does Kat and Dottie, if Dottie is a qualifying child, do both of them have social security numbers valid for employment? Yes. Does Kat meet certain requirements if she is separated from her spouse and not filing a joint return? Well, she doesn't have a spouse. She is divorced. Like that was finalized. So she doesn't have a separated spouse. She is single in the eyes of the federal government. Kat must be a US citizen or a resident alien for all year. Well, she was a resident alien all year. She can't file the Form 2555. Spoiler alert, no one in our income bracket files a Form 2555. Her investment income must be $11,600 or less. Ditto there. People working with us will typically not have much investment income, if any at all. And she cannot be a qualifying child for EIC purposes of any other person. So what defines a qualifying child in this case? Is Dottie Kat's qualifying child for earned income purposes, for earned income tax credit purposes? Dottie must meet the relationship test, the age test, the residency test, and the joint return tests, but not the support test. And Dottie does not have to be Kat's dependent in order to meet the qualifying child tests. If Dottie meets the qualifying child for EIC tests for more than one person, only one of them can actually claim her. And again, it's emphasizing Kat cannot be the qualifying child for EIC of another person. So, does Dottie meet the relationship, age, residency, and joint return tests for Kat?
Yes.
Yes, yes she does. Does Dottie meet the relationship, age, residency, and joint return tests for Manny?
They're not the support.
She doesn't have to meet the support test, and she actually does meet the support test for both of them. Dottie is a qualifying child for either of them to claim under EIC.
But the tiebreaker goes to.
There is no tiebreaker rule.
Right.
Dottie could be used as a qualifying child for EIC by either Kat or Manny.
Only one.
But only one of them can do it. And looking at their respective earned incomes, it is to the household's benefit for Dottie, for Kat to claim Dottie for earned income credit. So once you finish out the Part B rules, if you have a qualifying child, then you have to look at, oh, there is an AGI limitation. Earned income credit starts to phase out at a certain point, and at the top end, people without qualifying children, their earned income credit phases out at about 18.5 thousand. With one qualifying child, where Kat is, her earned income credit phases out at $49,000. It's a very big jump. Earned income credit is primarily targeted at families with children. Or households with children, I should say. And these thresholds do change based on marital status. If someone is married, they have a slightly higher threshold. And if you see the threshold for married filing jointly with three or more kids, it's 66,819. That might have something to do with why our soft income cap is $67,000. We are heavily focused on people who are qualified for earned income tax credits. Our upper limit, like our hard limit, is about $83,000. That's the upper limit. That's the limit of low to moderate income households. If we go above that, we start violating the rules of the banks that have funded us. Wells Fargo, Charles Schwab. So that's how earned income credit appears in the publication 4012. There is technically a due diligence checklist.
But now you gotta answer all the questions.
Yes, let's see, you last prepared taxes 2 years ago,
Yes.
right? Yeah, then you very much remember this.
I went there, now I have to answer all the questions.
You remember this, yep. There is technically a set of due diligence questions that we are technically supposed to answer. EIC checklist. The reason I say technically is because they enacted this in 2021. And it caused an absolute uproar amongst VITA programs. Because these are all questions that if you have configured the return properly, they are already answered. So in 2021, they required that we complete all these questions, no, I'm sorry, it was 2016, 17, it's something in the late teens. There was 1 year that they required every VITA program to answer all of these earned income credit checklist, their due diligence checklist. And it angered everyone. No one liked this because all it did was waste people's time.
The software does it.
The software does it, yeah. And so the IRS, after that year, said, whoa, okay, we hear you. Sorry, you don't have to do this. So the software will handle this for us. If we have configured everything properly, then the software will automatically answer all these questions and we don't have to touch this section. If the taxpayer is not getting EIC and you think they should, then this checklist is a really good checklist to go through to make sure that you have configured everything properly and that you fully understand the taxpayer situation with regards to earned income credit. You can go step by step through all of these questions and it will tell you whether or not they are able to claim earned income credit and child tax credit. If you skip this and don't touch this screen, TaxSlayer will not care. TaxSlayer will just say, oh, well, you didn't do that. That's all right. So you don't have to touch that screen. And in past years, if you touch that screen, then it would force you to complete it. couple of years, it hasn't done that. So we should be fine. We'll see if this throws any errors when I go to e-file. I don't think it. Nope, it's permitted us to continue right on through. But just to make sure that you all have the same figures as I do, let's go through this as though I was explaining this to Kat. I'm going to go to the summary print screen, and because it is still early in the tax season, or it's prior to tax season, the summary print screen will be incorrect. So what we have to do is select that View Print Return button, and then open up this pop-up. And here we will have a return for, once we get through all the summary pages up front, we will have a return for Kat Castillo. We have her signature authorization page, which summarizes the return, and then has a place for her to sign. We've established her basic information up here. We've established her filing status, her family members that she is claiming as a dependent. We have her total income imported here from her W-2. There's no other income for us to worry about. Then we have some additional income, part of which is adjusted out because that was the $2,400 that we added in, and then the $2,400 that we removed, yielding an adjusted gross income of $37,488, which is then reduced by her standard deduction down to a taxable income of $15,588, which in turn translates into $1,558 worth of tax. Then we are able to take away child tax credit and credit for other dependents, which yields a remaining amount of, and then we take another $506 worth of other credits, which is where that credit for other which is where that credit for child care and child and dependent care comes in. That's part of that 506. And that completely wipes out her taxable income. That completely wipes out her tax. So she owed $0 worth of tax over the course of 2024. Even though she owed $0, she paid $1,268 worth of tax via her federal withholding at her place of employment. And then we have earned income credit, which she's getting. She's getting about $1,800 worth of earned income credit, and she still has $1,448 of child tax credit left that she is actually able to get back as a refundable credit. So she has $1,268 worth of payments she's already made and $3,303 of refundable credits, which means all told, she has quote unquote made payments of $4,571 on $0 worth of tax. Therefore, we're getting all that back for her, which probably makes her pretty happy. Unless she was expecting more. Sometimes you get taxpayers who are expecting a certain number, and if you don't reach that number, you might have to massage them a little bit.
Arizona has this little known excise tax, and people that are suspecting a nominal amount back, and they also get the excise tax back, they were very happy.
Yeah.
Makes you feel good. And in the live environment, obviously, you got the demographic questions that are inconsequential here, but
yes. Well, specifically, we'd be explaining this before we get to the e-file section. Because then people get really happy to give you bank account information.
which she opted not to.
Which she opted not to. So in this case, she has opted out of a direct deposit, but we are still able to e-file. So we can select e-file paper check. Since she has not insisted on getting a paper return, we'll select e-file paper check. We'll hit continue. The fee summary page will show up, even though free is free. So this is your chance to say, hey, free is free. You're saving about $300 here. There will be some custom questions. You'll notice this has skipped over the point where we normally enter the bank account information because she has asked for a paper check to be mailed to her instead. As a reminder, this is where I would want to highlight the address that we have entered and make absolutely certain that she is happy with mail going to that address. There will be a section here with the custom demographics questions and potentially some custom questions that we ask locally. And then there's the final summary page where we would scroll to the bottom and we would click ready to e-file and any other appropriate boxes, plus mark return as ready for review. And then we raise our hands, we say, hey, site coordinator, can you come over here and give me a quality review? And then that's it. Any questions about Kat's return? All right. So I will note here, this is just a personal note. The name for the scenario, Catalina Castillo, is the name of a high school classmate who passed away just before the pandemic. So this is my little way of memorializing her. So you can either click save and return if you want to head back to the summary screen and let the quality reviewers just be in the return, or you can click save and exit if you want to jump out to this screen and not leave someone's personally identifying information up if it's going to take a little bit for the quality reviewer to head over. And at this point, let's get complicated. Let's take a look at the next scenario. It begins on page 32 of the packet that I emailed to you, the print packet 2. This is going to be for Danny Dumas and the prior year complications. I will tell you ahead of time, you will probably never see a return as complicated as this one. This is intended to be a doozy.
I was gonna say, these are very easy, we just pump these to the site coordinator.
But where's the fun in that?
Where's the fun in that?
Yeah. Good, you're remembering to head back to the practice lab as opposed to log into the live software. Good. Yeah, this is intended to be a doozy of a scenario, but it is very much doable. And even though you will not encounter a single case that has all of these components all at once, every single component of this crazy complicated return, you will potentially see on an individual basis elsewhere. So this is kind of an amalgamation of, this is kind of a worst case amalgamation of things that you could potentially see on a rare basis throughout the tax season. You will see, for instance, prior year returns. Generally speaking, we do try, the site coordinators will try to ensure that prior year returns get sent to taxpayers, get sent to volunteers who were around for that prior year. Technically, if you are certified in 2024, then you are also certified to go back into 2023 and 2022 and 2021. And then past that, we don't really care about, because past that, the taxpayer can't get a refund. The only time that we will care about returns past 2021 is when someone is trying to catch up on multiple years and they know that they owe money from the prior years. Because this is a fun fact. If you have not done your taxes for more than 3 years, like if you have not filed a tax return that's more than 3 years old, you cannot get any refund from it. The IRS has already written off that refund amount, but you are still required to pay, because the IRS will get their pound of flesh. So we do try to encourage people to file their returns within 3 years if they're going to get a refund. But all that to say, you are technically, once you certify in 2024, you are technically allowed to do back taxes for people. And the reason is you don't have to have any of this memorized. You can always pull up, like I did previously this evening, you can always pull up the prior year 4012, and you can always pull up prior year versions of every publication. And it'll tell you exactly what you have to do for that year to resolve something. Again, typically we'll send prior year returns back to volunteers who were there during that year and therefore have practice in doing that prior year. But I have every bit of confidence that once you certify, you would be able to use the reference materials to solve a prior year return. Might not be as fast as, say, I could do or Mariella Montoya could do, because she is an absolute queen at tax returns. But you would be able to do it. So, examples of things that are going to be all amalgamated into this, but you will see on an individual basis once in a blue moon: prior year tax returns, marriages that have not actually been annulled, people who have the 1095A to fill out, people who still have to repay their 2008 first-time home buyer's credit, and a couple other things. Specifically, a big one is the prior year disallowance of a refundable credit. This has become more and more of a thing as more and more fly-by-night, borderline fraudulent tax preparers, or sometimes just straight up fraudulent tax preparers, proliferate. A lot of taxpayers get taken advantage of by people who will hang out their shingle real fast and then move on before the IRS can catch them in their fraud. And the person left holding the bag is the taxpayer. And we have seen multiple times a taxpayer shows up at our site and they were victimized by one of these folks. And this is how we can help them through that situation. So, Danny Dumas has shown up. He needs to file his 2023 tax return. He's got his daughter with him. He hands over those documents. So no complicated documents, it's just a Form W-2. Social Security numbers, Social Security cards, I should say. He fills out the intake sheet, says he's never been married. From 2008 to 2010, Danny and his then girlfriend Elise claimed a common law marriage and filed as married filing jointly because it gave them a big refund. But they broke up, he hasn't seen her in years, and they never actually formally got married. They just said they were married, and common law marriage is a thing in Texas. If you present yourself as husband and wife, or if you present yourself as spouses, then in the eyes of Texas, you are married.
No 10-year test?
There is no 10-year test. If you showed up to a formal event and said, hey, yeah, it's my spouse, from that day on, you are considered married in the eyes of Texas. Now, that really only formalizes once you sign some sort of legal document. So if you buy a house together and you represent yourself as a married couple when you're buying the house, or if you sign a government document like a tax return claiming that you are married, then you are most definitely married in the eyes of Texas. Now, why am I including this on here? Because there is a common law marriage in Texas, but there is no such thing as common law divorce. Danny is technically married. So when we go through that filing status chart, we have to follow the yes icon from that start here box. So, continuing. Daria lived with Danny all year, and she has no income. Danny pays for all of Daria's living expenses. Danny says he was temporarily unemployed in January and February of 2023, but he was rehired before he had to apply for unemployment benefits. And aside from his W-2, Danny had no other income in 2023. Danny says that he paid $1,950 for an after-school program in the fall of 2023 so that he could pick up Daria from school after work. He wants to claim the associated childcare costs like his retail preparer has done for years, and he has a note on his phone that Louisville ISD's employee identification number is that. Like, that sounds great, right? We can claim child and dependent care credit, right? Life events. Danny is actually does remember things, and does remember that he has had earned income credit, child tax credit, or American Opportunity Credit disallowed in a prior year. And he has actually marked that here, or should have. Yeah, right here. What happens when the thing that happens when that occurs, okay, stop selecting things. Stop selecting things. Okay. There is a way that we are required to notate this in a tax return. When someone has had a tax credit disallowed, we are required to record that on their tax return. And if we don't, that tax return will reject. There are still several tax returns from last year that are sitting in that rejected column because it was rejected because of this, and the taxpayer never came back in to fix it with us. It's outside of our control. We asked all the due diligence questions, but they just didn't tell us about this. So we didn't file the right form, therefore we couldn't file the return for them. We are ultimately able to file Danny's return, but I just need to show you how to handle a prior year disallowance. Danny says that the retail preparer who filed his 2020 tax return claimed earned income credit for him despite his daughter not being a qualifying child that year. And the IRS audited his 2020 return. That led to a major financial hardship and prevented him from claiming EIC in 2021 or 2022. But an IRS employee has told him that he could attempt to claim it again for 2023, which is correct. Some things happen when you mistakenly claim earned income credits or one of these other refundable credits. In essence, you are barred from claiming that credit for a certain number of years. If the IRS determines that you claimed that credit fraudulently, the limit is 10 years. You are not allowed to claim that credit for another 10 years after a fraudulent attempt to claim the credit. If the IRS determines that it was not your fault and you did not do it intentionally, then the limit is 2 years. The third year, you can try to claim the credit again, but you have to still acknowledge that in a prior year, the IRS said, no, you should not have taken that credit. So we want to get him his earned income credit because he does qualify for earned income credit this year. Then, further interview notes. When you ask about their living situation, it comes up that Danny bought his current home in 2008. He then remembers that he took the first-time home buyer's credit in 2008 and needs to make his $500 repayment. His original credit was $7,500, and he's made his $500 minimum payment each year. So what is this? And why do we care about something that happened in 2008? Well, what this is in the late aughts, in the late 2000s, Congress passed several bits of legislation that created the first-time homebuyer's credit. In 2007, the first-time homebuyer's credit was just a flat amount that you got back on your taxes on the year that you bought your first home. In 2009, the first-time homebuyer's credit was just a flat amount that you got back on your credit, on your tax return, the first year that you bought your home. In 2008, despite it being called a first-time homebuyer's credit, what it actually was a first-time homebuyer's tax time loan, interest-free, of up to $7,500. In theory, up to $8,000, but that involves a weird calendar thing happening between 2008 and 2009. But the long and short of it is, people who got the first-time homebuyer's credit in 2008, very specifically, were required to repay $500 of that credit every year afterwards, every tax year afterwards. And it comes due with their return as a additional tax. So we have to account for that on Danny's tax return. In theory, people had the option of paying back more than $500 in a given year. And in theory, people might not have taken the full $7,500 of credit. It's based off the value of the home that they were buying. It was a certain percentage of the value of the home, or $7,500, whichever one was bigger. 2008, booming housing market, everyone's first-time homebuyer's credit was $7,500, effectively. And virtually no one, in fact, I have never personally seen a case where anyone repaid more than the required $500 come tax time. In theory, it could have happened. I seriously doubt you will come across that case. Also, if you're keeping track of the years and the per year repayment requirement, no one should have the $500 payment requirement anymore from 2024 onwards. 2023 should have been the last year that anyone was making repayments. It's theoretically possible it might still be happening because of something happening weird, but it shouldn't appear anymore. And then you will have to deal with healthcare.gov coverage at some point. And the 1095A can, at times, be a bear of a form to deal with. And this is very, very common. Danny did not hand us his 1095A during the interview.
Well, worse than that, he said he didn't have it during 2 months when he was unemployed, and he had employer insurance, so he's obfuscating.
Yep. He legitimately might have employer's health insurance throughout. In fact, if you look at his W-2, he does. He's got employer health care for at least part of 2023. But he started the year with Obamacare, and then he got employed. and he forgot to update healthcare.gov about his new employment until June. And then halfway through June, he suddenly realized, oh, I'm double dipping right now. I need to stop healthcare. Or I need to stop healthcare.gov. I need to stop the federal plan, the subsidized plan. And then it got cleared out the rest of the year. And so by the end of the year, yeah, legitimately, he does not have healthcare.gov and he doesn't have government insurance. He has workplace insurance. Unfortunately, that means that this 1095A is particularly complicated. So I've just outlined a whole bunch of things happening on this return. And he's filled out a 2024 intake form, but it's for 2023. And so this is how we will typically do that. We'll just mark as one of the intake forms that someone gets, oh, it's 2023. So let's show you how that gets entered. First question is, why am I not seeing his return here?
23.
And it's because I'm in the wrong tax year. So, a reminder, to change the tax year, you just go to the Change Tax Year item and go to 2023. And it's going to show all this stuff. Or rather for you, it's going to show nothing, or maybe last year's sample scenarios if you were certified last year. But you will have the option to start a 2023 tax return. So go ahead and do that.
That's not the Musketeer.
That he is. I may have random little pop culture references all throughout my sample scenarios. All right, so remembering the order of operations, you are currently face-to-face with the determining filing status. Let's first check, can Danny claim Daria as a qualifying child for dependency purposes? Is Daria Danny's child?
Yes.
Sure hope so. Is Daria one of these three things? Under age 19 at the end of the year, under age 24 at the end of the year, and a full-time student, or any age and totally and permanently disabled?
Yes.
She is under age 19. Did Daria live with Danny for more than half of the year? Yep, all 12 months, the entire year. Did Daria provide more than half of her own support?
No.
No, she did not provide any of her own support. Daria is not filing a joint return, and can Daria answer all these questions in the affirmative, or can Daria pass all of these tests for anyone else? And the answer is no, because she's going to fail the residency test for everyone else. So Danny is the only person who can claim her for 2023. And Daria is Danny's qualifying child for 2023. So now that we've determined dependency, now we look at filing status. Start here. Was Danny married on the last day of the year? He tells us no.
Fabulous.
Through our interview, we determined that Danny and Elise were in fact in a common law marriage, and they have never gotten it annulled. Therefore, technically speaking, yes, Danny was married on the last day of the year. Did Danny and his spouse live apart all of the last 6 months of 2023? Yes. He states he hasn't seen her in years. And 2010 was the last time that he says that they claimed a common law marriage together. Context clues say, okay, they haven't seen each other for a while. And I'm being very specific here about 2023. If I was being even more specific, then I would be using the 2023 4012. But in this case, these things do not change. These high-level things do not change between the tax years. We'll see what happens in 2025, whether that changes, but they did live apart all of the last 6 months of 2023. And did all of the following apply? Is Danny filing a separate return from Elise?
Yes.
Yes. Did Danny pay more than half the cost of keeping up his home? And was his home the main home for his child, stepchild, or foster child for more than half the year?
Yes.
And is he able to claim that child as a dependent, or is he claiming that child as a dependent? Yes. Therefore, we can select head of household. So this is that edge case where we are permitted to select head of household for someone who is married. If Elise had lived under Danny's roof for 1 day, anytime from July to December of 2023, we would not be able to do that. Taxpayer information. Once again, I may be trying to drive a point home. So based off his social security card, we have to put Daniel Do-Ma. Even though his W-2 says it properly, the Social Security Administration understands his last name to be Do-Ma. Whoever the Social Security data entry clerk was must have not liked the French. His date of birth is not tricky because he's got an American document. He is an idealist and wishes to contribute $3 to the presidential election campaign fund. He has a nice, simple address in the colony. His phone number is actually provided, unlike Kat's. And that's all you gotta do. So complete your data entry, and then it'll then kick you to, hey, do you want to add dependents to this return? Which, yes, we do. And I know I'm going a little fast through here. Whenever you get to Daria's information, you may praise whatever deity you choose. I have finally given you someone whose stated name actually matches their social security card. So enter Daria Do-Ma's name.
Override to do.
Yes, you have to override his name being imported in. You can enter her date of birth, which I have done no trickery with, her social security number. She is a US citizen. She is her father's daughter, who lived with him for all 12 months in 2023. And none of those boxes apply. Then you can click continue. You don't have any other dependents to add, so you can continue past that. You don't have birth, death, or hospital records to add. You can continue past that. That should dump you into the income screen, wherein we have a W-2. And joy of joys, this is a relatively simple W-2 to add in. I have done no trickery with this one. It's a standard W-2. It is employer's identification number of 842769255. Do any of you live in or near the colony?
It's like a 10-minute drive from my apartment.
Okay, yeah. This pretend charity is actually very closely based on the Next Steps the Colony. They were one of our key partners during the pandemic. They worked very closely with us during the pandemic emergency rental assistance era. And so they're pretty fantastic. Pam Santiago is the executive director there. So we have employer identification number, employer's name, employer's address, zip code, city, and state. Again, no tricks on this one. Employee's full name. We are unable to correct the name to how the W-2 shows it, but we are doing everything we can to make the W-2 match as closely as we can. We have an address here, a zip code, a city, a state for him. Should import properly. We have wages, tips, other compensation, box 1, box 3, 5, boxes 2, 3, 4, 5, and 6 we do need to correct manually because it'll import the standard. It'll pretend that boxes 3 and 5 are the same as box 1 at first. We have to correct that as always. We have a code delta in box 12A for 2546. We have code delta delta in box 12B for 7860. Retirement plan is checked. And that's that. Nice and simple W-2. And no other income for him. Now we start in on the funky things. So, out of no particular order, why don't we talk about Danny's desire to claim child and dependent care credit. I'm going to go ahead and pull up the 2023 4012 again, and we're going to take another look at that. Child and dependent care credit expenses. Who is a qualifying person? A qualifying child who was under age of 13 when the expenses were incurred and who can be claimed as a dependent. Any person who was incapable of self-care, whom the taxpayer can claim as a dependent. Or any spouse who was physically or mentally incapable of self-care. Does Daria qualify? So Daria was born May 30th, 2009. Daria is 14 in 2023. Danny needs to amend his 2022 return if he managed to successfully claim child and dependent care expenses, because Daria was not qualified that year either. Daria is not a qualifying person for child and dependent care because she's too old at this point. People will often not realize why their return has suddenly dropped a whole bunch. My return last year was $1,500 more. What happened? Well, people will often forget that their kids can age out of credits. In this case, Daria has aged out of the child and dependent care expenses. The most common reason for someone to get caught up by that is when their kid turns 17. When their kid turns 17, their kid no longer qualifies them for the child tax credit. Child tax credit is for kids 16 or younger. And people will oftentimes get thrown off by that, and that's one of the leading causes for someone to not get as much money as they were expecting from their tax return. So whenever people are claiming child tax credit, whenever their kid is turning one of the magic ages, 13 or 17, or is going to the next year, it's a good idea, it's a best practice to remind people that, hey, just so you know, your kid's 16 this year, next year they are not going to qualify for child tax credit. So be prepared, make sure that you have your tax withholdings set up to account for that lack of that credit.
So, in this case study,
Yes.
on May, like on May 30th, 2023 is when Daria completes 14 years of age.
It's last day of the year.
No, in this case, it is actually, I see what you're getting at. In this case, it is under age 13 when the expenses were incurred. So yeah, you're right. There's a section during which she would still have technically been qualified for a portion of the year. But that's not, I should probably specify that in the actual interview itself, but that is not the portion of time when they were claiming the child tax credit. Right. 2023, at the end of 2023, she would have been, one on May of 2010.
Right now. 2009.
2009. She was born in 2009. She'd be one on, yeah, I should have had her born in 2008 instead. Oops. Yeah, so you're right. There is actually a portion, if we do the exact reading of this, there's a portion of the year when she could technically have qualified for child and dependent care expenses. I will need to specify, thank you for helping me proofread the scenarios. I will need to specify that. Oh no, I did it. I did.
Yeah, you have. I just saw that. Yeah,
Fall of 2023.
yeah.
Yeah. So Daria was already 13 at that point. She does not qualify. Yeah, you had me doing the mental math as well on the, I misspoke earlier. 2022 tax return, that was actually totally fine. 2023 tax return, all the childcare expenses before June would have been fine. But in the fall is no longer qualified.
So, I mean, we are filing the tax for the year 2023.
Mhm.
So shouldn't that be like, I don't know, like, okay. Okay, cool. Yeah, got it. Yeah, sorry.
Yeah, we're preparing the taxes for 2023, and
Yeah.
2023 is the period during which I think you're going down the tax season versus tax year thing.
Yeah, yeah.
Yeah. In 2023, he would have had to prepare the 2022 taxes,
Got it.
but we're looking at calendar year 23 right now.
Got it. Yeah.
So he should have filed this return in 2024's tax season, but he didn't. So he's coming to us now to file back taxes. Yeah, it gets real messy. There's a portion in our shared file system where it switched from talking about tax seasons to tax years. And so it looks at first glance like there's a missing tax year in there. And it's because I switched to talking about tax seasons instead in our filing system.
So for the 2022 restatement, might he have a partial day?
2022, he actually could claim child and dependent care the entire year.
Okay. Okay, so there's no restatement.
There's no restatement. I misspoke earlier.
So even after May, there's no restatement if she went in the fall.
In 2023,
Okay, yes.
because she would have turned 12 in 2022.
So she would have been 13 on May.
Yeah, she would have been 13 on May 30th of 2023.
Thank you.
Birthdays, dates. There's a reason I just go to the date calculator online to figure out how old someone is. Yeah. But complication, he cannot claim child and dependent care expenses. And sometimes people will not realize why, and this is where you can pull up the 4012 and show them. Like you can pull it up on screen, or if you have a physical copy, you can flip to the page and show them, look, the IRS instructions outright say, I'm not allowed to get you this credit because these are the qualifications for the credit. And sometimes you do have to walk taxpayers through exactly what's going on. And generally speaking, when you point that out to them, they will be understanding and they'll go, oh man, that sucks, which it does. They were expecting money. You're not able to get them that money. So you can sympathize with them, you can empathize with them, like, oh, I remember when my mother was no longer able to claim me, oh, she was upset at the amount of taxes she suddenly had to pay. But that is the correct way to prepare the return.
Was he the one that had his tax returns prepared by somebody else in the prior year, or was that?
Danny?
Yeah.
Yes.
Okay, because if he had it prepared with us in prior years, the software would have not allowed that.
Yes.
So because the fly-by-night.
Yep.
Okay.
All right. Well, it's timed me out, so let's get back into his return. Ignore all the other sample returns that I had posted there. So we haven't entered any child or dependent care expenses. What else do we need to address? We need to address why don't we skip the prior year disallowance for the time being? Let's talk about their first-time homebuyer's credit. How do you address that? Well, enter into the form finder, first-time homebuyer, first-time home. Repayment of the first-time homebuyer credit. That'll pop up. It is under the additional taxes section, or the other taxes section is how they describe that. And this is how you fill out the form 5405. The first question is, did the home stop being the taxpayer's primary residence during the year that you're filing taxes for? Because one of the rules is, if you sold your home that you acquired using the first-time homebuyer's credit, the entire remaining balance of that credit is due that year. Yep, because in theory, you should have gotten that money from the sale and you can repay the feds immediately. Generally speaking, that doesn't typically happen with people who have this credit, but it could. If you do yes, then they have to repay the remaining balance. Repayment of credit. Check here if you purchased your home in 2008, and then you have to enter the full amount of credit. And they're supposed to have this memorized. They're supposed to be able to provide this every year. If they don't have it memorized, you have two options. You can either look at their last year's tax return and import information off of that, or you can use this click here button. When you click on the click here button, it'll take you to an account lookup tool. And using these four things, you can go to their actual first-time homebuyer credit account lookup, and it's going to say, oh, don't misuse this. Technically, they have to be the one entering this information, not us. But you can just, the taxpayer is going to be seated right next to you. You can just get to this page and flip the keyboard over to them. So you enter their social security number, you enter their date of birth, you enter their street address and their zip code, and it will spit back out, hey, based on the information you entered, this is the first-time homebuyer's credit situation for this person. And it'll tell you how much was the credit originally claimed for and how much has been repaid. Generally speaking, you can just take however many years it's been between 2008 and the tax year that you're preparing and multiply it by 500. And that will find the amount that has already been repaid. Yep, so 14 years, $7,000, and he's got to repay 500 more, and that will be his last payment. But that's all you have to do. You have to enter the full amount that was claimed, the amount that has been repaid so far, and at least $500 of repayment for this tax year. And whatever number gets entered here in this box ends up as an additional tax during that particular step of the tax return. And then you can hit continue, and that'll do all the trick for you. Yes?
Where do you see the $7,000 that he's already paid?
So you can either find that by looking up, you can either look on prior year tax returns to see how much has been repaid and add 500 to that, or you can look it up on the lookup tool, or you can just say, well, 2013 is 14 years of repayment after 2008.
Okay.
Therefore, most people will pay back only the $500, so just multiply 500 by 14, 7,000.
Okay, got it.
I have never once seen anyone repay more than the $500 minimum. In theory, someone could have done more, but almost no one does. All right. Last thing, two more things that we got to worry about. Let's talk about the prior year disallowance of a credit. There's again a couple ways to look at this. You can either go to the deductions menu and the credits menu after that, and then there will be a section for claiming earned income credit or other credits after disallowance. Or you can just type in disallow, and it'll take you to the form 8862, which we must complete. Information to claim certain refundable credits after disallowance. So remember, I mentioned for 2 years, Danny was not able to claim earned income credit. Like, he was explicitly forbidden from claiming earned income credit. If the year that we're preparing for him happens to fall into one of those 2 years, we have to use this menu that says not eligible for EIC. But since we're in year 3, and since the IRS decided you didn't do this intentionally, the form that you signed didn't have you trying to claim EIC, this fly-by-night preparer changed the form after you changed your 1040 after you signed the form and added in this EIC. It was not your fault. You claimed this mistakenly. So year 3, you can claim it again. Therefore, we'll go to information to claim certain refundable credits after disallowance. And we can claim EIC after disallowance. And it's going to take us to what is essentially a shorter version of the checklist. And it says there's a couple options here. One of them is, is it only because you incorrectly reported your earned income or your investment income? Well, no, that wasn't the case. A child was claimed who was not supposed to have been claimed. So the IRS asks specifically, hey, just making sure, this kid lived with you the required amount of time, right? So we enter the number of days that they lived with him in this case, 2023. So 365 since it was the whole year. If this was a 2024 return, we'd need to put 366 if it was the whole year. And then check if any of these things apply. Which, no, Daria's still very much alive and having fun doing her homework off in the waiting area. Daria is not the qualifying child of more than one person. She can only qualify to be Danny's qualifying person for earned income credit. And no one else lived with them for more than half the year. No one else lived with them at all. Click continue, and it's gonna say 1, as in, I agree, you have 1 child for earned income credit purposes. You can click continue and then double check into the claim CTC, ACTC after disallowance. So the additional child tax credit and the additional child tax credit can be affected by this as well. And it says, hey, would you like to claim child tax credit for eligible dependents? And you can click claim credit. And the system will look at the flags that you have set for Daria and figure out, okay, is she actually supposed to be qualified? And the system's going to say yes in this particular case. Oh, double check. No, that means you're chasing down the right rabbit hole. Check the basic information and make sure that you have everything recorded properly.
Yeah, I also see it's disqualified, so I'm not sure. Oh,
Interesting.
I have the right birthday, yeah.
Huh.
now I see that it's qualified.
Okay. I was gonna say, that should be working. Maybe it's just TaxSlayer being a little ornery the first time you see the screen. Again, if we have any doubt, we can actually go back
Qualified,
to.
she's
Okay,
qualified now.
perfect. So that must be a weirdness about TaxSlayer that's happening right now. If we ever have any doubt, we can go back to the 4012 and there's an entire section on child tax credit. And we can double check to make sure, does Daria qualify? Is Daria under age 17 at the end of the tax year? Yes. Is she a US citizen or US national or resident alien? Yes. Is she claimed as Danny's dependent? Yes. Is Daria Danny's son or daughter or one of these other things or a descendant of any of them? Yes. Did Daria not provide over half of her own support? Yes. Did Daria live with the taxpayer for more than half the year? Yes. And does Daria have a social security number that is valid for employment, issued before the due date of the return? Yes. Yes, she does. And then there's additional stuff for additional child tax credit. Taxpayers with more than $2,500 of taxable earned income may be eligible for the additional child tax credit if they have at least one qualifying child. Limited to $1,600 per qualifying child, and there's a bunch of other stuff. And there's a little note here of see disallowance of certain credits in tab 1 earned income credit if the taxpayer received the letter saying they have to complete the form 8862. Which is exactly what we're doing right now. This is how we make sure that the IRS is going to say, no, actually you're good. You can claim these credits again. So you complete that form, you hit continue, and that should make that number a little happier. But y'all's number should be significantly happier than the number that I got.
Right. I have a 20.
Yep, that should be about right. And the thing that we are missing is the last thing to add here. It's the 1095A, which we figure out as we're discussing the summary with him. We're summarizing everything, and at some point he mentions the magic word, oh yeah, I got Obamacare. We ask him, hey, do you have a 1095A? I don't know. Can I see all the tax forms you got? Yeah, sure. And then he pulls out the 1095A. So, did Danny, his spouse or dependent, have insurance under the Affordable Care Act? If so, select yes. You must report Form 1095A for the IRS to accept your return. They did. So we have to click yes here, and then we have to click continue. And instead of tossing us back to the summary, now it's going to say, hey, let's verify who is in your tax household. And the reason is we need to verify not just who's in the tax household, we need to verify who is in their health household. And these are different households. Tax household is everyone who appears on your return for tax purposes. It is in a health household is everyone who appears on your return for healthcare.gov purposes. And the two are not necessarily the same. If they differ, there is a healthy way for it to differ, and there is an out-of-scope way for it to differ. If the health household is smaller than the tax household, that is okay. If there are people in the tax household, if there are people on the tax return that are not in that are not on the Affordable Care Act plan, that is okay. If there is someone on the Affordable Care Act healthcare plan that does not appear on the tax return, then that is a split reconciliation of the Affordable Care Act premium, and that is outside of our scope. If there are more people on the 1095A than there are on the tax return, then we cannot touch that return. They will have to go to a paid preparer instead. So we're right now verifying, okay, is this the health household? And the answer is yes, thankfully. This is indeed the people who appear on the health insurance plan. Are you allocating policy amounts with another taxpayer, or do you want to use the alternative calculation for year of marriage? If they select yes to either of these, then they are outside of our scope. Are you required to repay all of the APTC received? In most cases, the answer is no. Only answer yes if you were not considered lawfully present in the US. Note will automatically calculate a full repayment of APTC when modified adjusted gross income, MAGI, is greater than 400% of, aka more than 4 times higher than the federal poverty line. So what does all this mean? First off, if you are not here with the permission of the federal government, then you were not supposed to get the Affordable Care Act plan. That should not have happened. I've never seen it happen, but in theory, if that happens, all advanced premium tax credit must be repaid. Similar story, if someone somehow got an Affordable Care Act plan and then earned 4 times the federal poverty line, then they are supposed to repay all of the advanced premium tax credit that they received. It is incredibly rare for that to happen. I have never seen anyone who got Affordable Care Act and then earned more than 400% of the federal poverty line.
16,000.
Federal poverty line differs based on family size, but I'm pretty sure it's 16,000-ish for a single person, and then for a 1-person household, and then I believe it's 18,000 for a 2-person household, which, like, just try living on 18,000 in Denton County in annual income. That's very unlikely. Possible, but very unlikely. Realized I'm missing some chats. Perfect. That'll work. All right, so here we answer no. And then, do all forms 1095A include coverage for January through December with no changes in monthly amounts? Remember, if any family members are under different health insurance plans, you'll have more than one form. It is theoretically possible that, for instance, Daria, well, bad example, a college-age kid might get onto the Affordable Care Act plan on their own, and then the parent is also on the Affordable Care Act plan. It's possible for that to happen. Very unlikely. And to my knowledge, I've never had to deal with this before, but to my knowledge, I believe Affordable Care Act plans get reconciled with whoever claims the dependency. I think that's how that works. My understanding is that that situation ends up out of scope for us because we're having to reconcile for the person claiming the dependency, we're having to reconcile someone who is not on, well, no, it would be on their return. It's messy. I've never seen it happen. If it happens, we'll look up exactly what to do. What's more common is you'll see cases like this, wherein they have provided a Form 1095A, and unfortunately, we have to answer no There is not coverage with no changes in monthly amounts from January through December, which means we have to enter 36 separate numbers. So it takes a little bit to enter this information. If you select yes, that everything's the same, then that becomes really, really easy. All we have to do in that case is we'll have to enter 3 numbers. We would have to enter these figures right here. If all the monthly amounts are the same, then we can just enter these 3 figures and that solves everything for us. However, we answer no there, so we enter this. And that's just data entry. Then you hit continue, and then it's going to ask, hey, what are your dependents' AGIs? Because what we're having to do now is we're not only having to assess the tax household's income, we are now having to assess the health household's income. So the way that this works is we have to prepare, or we have to know how much was the AGI of their dependents. And then we have to add that to the taxpayer's income, their AGI. And that yields the modified AGI of the health household. And the MAGI, the modified adjusted gross income of the health household, is what healthcare.gov bases its premium amounts off of. So this is where it's worth mentioning, and I mentioned this in one of the prior classes, but I want to emphasize again, this is how the Affordable Care Act works. For anyone who doesn't know, the Affordable Care Act works by the federal government subsidizing certain insurance plans for taxpayers in advance. When you sign up, when someone signs up for Obamacare or a marketplace plan or an Affordable Care Act plan or a healthcare.gov plan, what they do is they estimate how much their health household will make in the next tax year. You sign up either when a life event occurs or in December. Like right now, I think we are in the enrollment period for the Affordable Care Act. If not, then we're about to be. But in the enrollment period, you sign up at healthcare.gov, or in a state that isn't Texas, you sign up on the state marketplace. And then you say, well, in 2025, I estimate that I am going to earn $25,000. Based off that $25,000, healthcare.gov takes that figure and says, okay, presuming that you earn $25,000, this is what the formulas say we will pay on your behalf to healthcare companies in order to make that insurance more affordable. So I'm going to pull numbers out of a hat here. The healthcare.gov says based on $25,000, we're going to pay Blue Cross Blue Shield $300 in advance every month to subsidize your health insurance. And then Blue Cross Blue Shield will send you a bill for the other $200 that you need to pay. And we'll make this arrangement throughout the entirety of 2025. So cool, I sign up for a healthcare plan, I put in my estimated income, and then I get a bill every month for $200. And I get health insurance because of that. Sounds great, right? Well, we provided an estimate. What we have to do at the end of 2025 is I then have to file my taxes in tax season 2026. And I have to tell the IRS, I have to tell the federal government, well, actually last year I estimated I would get $25,000, but actually I earned $30,000. Then the IRS and healthcare.gov, the federal government, looks at that and says, oh, so your estimate was off. And actually, we should have based our formulas around $30,000 of income. So putting that into our formulas instead, it actually says that we should have paid Blue Cross Blue Shield $200 in advanced premium tax credit. We should have paid them $200 in the subsidy, in the monthly subsidy instead of the $300 that we actually paid. So you owe us the $100 a month back because we weren't supposed to have paid that. So fork over $1,200 as part of your tax return. And that's how the federal government reconciles your estimated income versus your actual income, and therefore the estimated payments that they have already made versus the actual payments they actually should have made. It works the other way too. If I instead say, well, I had a bad year, I only made $20,000 instead of 25,000 like I thought I would. If that happens, the feds then say, oh, well, our formulas say we should have paid $400 a month last year instead of $300, the $300 that we actually paid. So we didn't pay them enough. You paid $1,200 more than you were supposed to. Sorry about that. Here's the $1,200 you weren't supposed to pay. So it works both ways. And at the end of it, we reconcile down to what healthcare.gov should have paid. But sometimes that can catch people off guard. I have had some very unfortunate situations before where I've quality reviewed returns, and the worst one was someone who had $10,000 of gambling winnings and $12,000 of gambling losses, but their losses didn't show up on their deductions because they didn't qualify to itemize. And as a result, their adjusted gross income looked $10,000 higher than it should have been. So to healthcare.gov, their adjusted gross income looked $10,000 higher than their estimated income. And healthcare.gov charged them out the wazoo for repayment of advanced premium tax credit. And there was nothing we could do about it.
Because it took the standard instead of the itemized.
Because he had to take the standard. His itemized couldn't get up high enough to beat it. And gambling losses are only deductible to the extent that you had gambling winnings. And he couldn't include any of them. It sucked. That quality review took a good hour walking him through what had happened, why it happened, and his options for continuing. And ultimately, he did end up filing with us, but he had to take a long while to process that. And entirely understandably so. It was an unfortunate interaction of the way that the gambling winnings system and the Affordable Care Act interact. And that's the human element. You have to understand that emotions run high when things go unexpectedly, especially when they go unexpectedly in a negative direction. So there will be cases of people who have to repay advanced premium tax credit. There will also be cases where people that you're working with will get a whole bunch of advanced premium tax credit back as a refundable credit. It's a nice little silver lining to not having earned as much income as someone estimated. This is also why I will typically advise anyone who's looking at Affordable Care Act plans, overestimate your income. Just to play it safe and not be caught flat-footed at tax time, go on the higher end of your estimate. Yes, you're gonna have to pay a little more throughout the month, throughout the year and the month, on each month, but you won't be caught by surprise in a negative way come tax season. So, in this particular case, Daria does not have any AGI of her own, doesn't have any income of her own, so we can ignore the Magi thing. In a real case, if the kid had income, we would have to do their tax return first. That way we had their AGI to add to their parents' return. But in this case, we're fine. So we can click continue and voila, you should have, at this point, $449 as the final refund amount.
Agreed.
Fantastic. And that brings us to the end of my scripted stuff for today. Congratulations, you've made it through the doozy of a tax problem, wherein I threw as many complications as I felt was reasonable at you. Again, just to emphasize, you will not run into a tax return that messy in reality. What you will run into is bits and pieces of that tax return here and there throughout the tax season. Most people that you help, they're going to have a W-2, maybe up to like 3 or 4 W-2s, depending on how many times they job switched or how many jobs they worked concurrently. And then that's typically it. They might have one dependent to add, they might have a spouse, but generally speaking, most people just have a W-2, maybe an interest form, and then that's it. Most people, we can get their returns done in 30 minutes flat. The average is around 45, but a lot of folks we can get done real fast.
Now, did they come back the next day or the next week for they drop the taxes off? It doesn't get quality reviewed or double reviewed that day?
It does.
Oh, it does?
Yeah, it gets quality reviewed right after you finish it.
Okay.
So in this case, we would,
So they come at 5 o'clock in the afternoon and you got 6, you start the quality review, you have them wait until you get through the 6, or you just have them come back the next day?
oh, no, we'd finish the quality review.
Okay.
We try not to send taxpayers out the door until they've been completely done,
Got it.
start to finish. And we typically will not start a return
After 4:30.
after, yeah.
Got it.
Yep.
Makes sense.
In fact, our public times, we have the room usually reserved to the round hour, and then we end our public times a half hour early, just to make sure that someone doesn't show up at 7:59 saying, hey, can you do my taxes? And we're closing up the site. But no, we will absolutely do the return. Here we would explain to Daniel, hey, this is how your return is working. And then we'd call someone over to quality review right then and there. They sit down, they quality review stuff. We print off the return. We have Daniel sign it, or we have Danny sign it. And then that night during site close down, we look at the signed 8879. We say, hey, we got your signature. It matches everything all the details match between the system and the printout that we have. Therefore, submit.
Okay. Thank you.
Yeah, of course. All right. Any questions about the 2 returns that we've gone over before I assign you our homework?
So I can see at my end that it asks me for taxpayer consent and a taxpayer primary PIN. So have I done some mistake, or is
Nope.
this expected?
Nope, that is standard, and it is something that has not been activated yet for the 2024 tax return. Or maybe they've done away with it completely. But that's the global carry forward consent.
Right.
So let's go through return details. He wanted a direct deposit, I think.
Yeah.
Well, we'll presume that he did. We'll hit continue.
He gave his routing number, so yes, I would presume so.
Then bank account information, we have Wells Fargo, in Texas and Oklahoma, therefore. Nine. Deposit amount, I'm going to hit pull refund since I see the pull refund button. Account number. And then enter it again. Continue, and then this is the global carry forward consent. This is something that taxpayers can either accept or deny. They don't have, or decline. They don't have to accept this. What this is this would allow Danny to go to any VITA site in the globe across the world. He could be deployed as a military attaché to Germany and get his taxes done at a VITA site on the military base in Germany, Ramstein Air Force Base. And the moment that if he hits accept this year, the next year, whenever he provides his social security number at a VITA site, it'll say, hey, we have your information from the site in Carrollton. Would you like us to import that information? And in Germany, he'll be able to say, yes, let's import that, and it would pop up all the information we already entered. Or if he declined, then it wouldn't. And it's all just basically, does next year's tax preparer have to redo all the data entry, or can they pull forward information and then just double check what has been imported? And it's a time-saving measure. The information is kept on a secure server in Georgia. TaxSlayer keeps the information, the IRS keeps the information. And the only way it can be accessed is when Danny provides his social security number to the VITA site.
What's the primary PIN in this case?
The privacy PIN, if someone declines, then they don't have to enter the privacy PIN or the primary PIN at all. But if they accept, then technically the taxpayer and the spouse have to provide a PIN number of their choice.
Oh.
A 5-digit PIN number of their choice.
We just put in the zip code.
You can certainly do that. Technically speaking, and definitely if an IRS spec manager is on site, they are supposed to be the one whose fingers hit the 10 key to enter the 5-digit code. In reality, you can just ask them, do you want to put any number here, or do you want me to just put your zip code?
That's the way we did it, yeah.
Technically speaking, they are the ones who are supposed to enter the code. But I've never seen where they actually get asked the taxpayer PIN. But the primary PIN date you do have to put today, or whenever they're providing the PIN number, and then you can hit continue. There's custom credits, custom questions, and then there's the submission page as we are accustomed to. So we can hit ready to e-file, review, wait for signature, why not? Save and exit, and this is where we would call someone over to QR. Good question though. I'd forgotten that they haven't activated that for 2024 just yet. Any other things that I haven't covered that you'd like some more info on?
And of course, we'll pick it up for the next return. This is set to 2023 as we.
Yes, make sure that you're in the right tax year every time. Good point.
How are you going to share the video? Like, do you have a time in mind by when will the videos be released?
I do not at the moment. I'll have to look at that. This is the first year that I'm recording any of our trainings. typically I prefer not to do, hey, watch this video, because personally, that's not a good way for me to learn. And it's also not a way for me to meet all of our volunteers and answer questions and make sure that information gets conveyed. But I will try to find some sensible way to share that in the next few weeks.
Okay.
All right, well, if you don't have any more questions, then I do still have homework for you for one more set of trainings. And that homework is Advanced Scenarios 7, 8, and 9. So remember, Advanced Scenarios 1 through 6 were just scenarios that they gave you a situation and asked you questions about the logic of that situation. Advanced Scenarios 7, 8, and 9 give you sample tax returns to prepare in TaxSlayer. Go ahead and prepare those 3 returns in TaxSlayer. I should have prepared you adequately to do most of these returns. Just one thing to note, they will have the 4 X's thing. So anytime you see 4 X's in the training scenarios, just remember to put any 4 digits of your choice. Generally speaking, 1, 2, 3, 4 will yield results that other people have entered. If you don't want the system to import stuff, pick 4 digits other than 1, 2, 3, 4. There are a lot of places where you're going to see it say your city, your zip code, or YS. YS is an abbreviation for your state. You can enter pretty much whatever you want there. I would recommend sticking with Texas so that weirdness state-wise doesn't happen. There will be W-2s in here that have state information, including state taxes paid. Just enter the W-2 as it's written. It's gonna be weird, it's gonna look weird, but we're not doing a state tax return anyways, so it's not gonna matter.
So we're back here in 2 days, right?
Yep,
Okay.
back here on Thursday evening, or if you're gonna join on Saturday, then Saturday afternoon.
I'll be here Thursday.
Thursday it is. Awesome.
Okay.
Thank you for spending another evening with me.
Thank you.
I might not come on Thursday. I'll probably join you on Saturday. Yeah.
That works just fine. We'll be going over the same materials.
All right. Thanks. See you guys. Bye.
Good night. All right.
Take care. All
And
right.
I know I'm not teaching tomorrow because I'm playing tennis and I'm going to a breakfast.